What do y'all think about that? That's actually an old intro I made back in the day. Anyway, welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to talk about Jeremy LaFoofoo. No, I'm just kidding. We're going to talk about something educational today. My personal opinion on why I do not like the traditional IRA. Now, if you don't live in the United States, this doesn't freaking apply to you, okay? You can still like the video, subscribe, give me a $10,000 super chat, whatever you want to do. But I don't know how it freaking works in Canada or Europe, and I don't care. I'm an American, okay? I just unplugged my mic. We should be good now. Anyway, like I was saying, I do freaking taxes for people. And I see people paying massive amounts of taxes because they have traditional IRAs. Now, an IRA in the United States is a tax advantage account where you contribute money over your lifetime. If you have earned income, that means you go to work, you have work income. You can't just like be a rich kid, not work and collect dividends and put that into an IRA. You have to have earned income. You contribute to it over your working life. And then in retirement, you can start taking the money out without penalty, 59.5, and spend that on whatever degenerate things you want to do in retirement. However, there's a big tax problem with the IRA, specifically the traditional IRA. Now, if you don't know what the freaking difference is, we're going to go ahead and do a quick introduction to the IRA, okay? I'm not going to give you feedback. Get out of here. So, here's some of the basics, okay? And I know you get this is boring. Oh my God, tell me about 10x stocks that I will pay massive taxes on because I'm a clown and I trade. There's two types of IRA classifications, ways they're taxed. There's traditional IRAs in the middle, and there's Roth IRAs on the right side. You can contribute $6,000 to either one of them, or you could do $3,000 into one or $3,000 into another. Once you hit the age of 50, you can put in $7,000 total per year. And you can split it however you want. Now, there are limitations to, being able to contribute to a Roth IRA. And there are limitations to be able to make a deductible contribution to a traditional IRA. But there are ways, and if you want to do this, you should really consult like your own CPA. I'm not your CPA. You can do a non-deductible contribution to a traditional IRA and then convert it to a Roth. Okay, but if you're going to freaking do that, go talk to a CPA that is you're actually paying. However, the very basic information is that you can put money into these tax advantage accounts and they have some type of tax benefit. Taxes are huge. I try to explain this to you freaking clowns all the time, and nobody listens to me. I say, look, me, Kevin, my stepbro, my hero, my confidant, and my idol, if he has a short-term capital gain, let's say he buys a stock and sells it 10 days later and he makes $100. After taxes, he's going to go from having a $100 gain to about a $45 gain. That's right. The government, especially if you get into a high tax bracket or you have a good year, will tax the ever-living crap out of you. When you put money into these accounts, you get tax benefits. Now, the main thing you want to understand is when you contribute to a traditional IRA, you get a tax deduction now. Basically, if you put $6,000 into your traditional IRA and you qualify for the full deduction, it's basically saying you made $6,000 less when the government looks at how much tax you owe. Okay, it comes right off your income, $6,000 less. And when you take the money out in retirement, 59.5, whatever comes out is taxed as ordinary income, working income, basically. Save money now, pay taxes in the future. Roth IRA is exactly the opposite. You pay the taxes now, so you have to earn like $7,000, $8,000 something dollars in reality, pre-tax. You get taxed on your earnings, so basically a check gets deposited into your bank, and then after you pay taxes on it, and then you go ahead and contribute that to your Roth IRA. The benefit is, once the money's in the Roth IRA, it grows tax-free for the rest of your life. And when you hit 59.5, you can start taking the money out without any freaking penalties, contributions, and contributions without, being penalized. But very simply, save taxes now, traditional IRA. Save taxes in the future, Roth IRA. Now, people do all these freaking crazy comparisons of these two things. So people are like, oh, well, if you're in a high tax bracket now, you should contribute to a traditional IRA. And maybe that makes sense. I'm not saying you shouldn't. But there's one massive problem with the traditional IRA. It's a huge freaking problem. And I've noticed this. Now, I've only worked in tax for like 8 months, but I went through a busy season and I saw a bunch of individual taxpayers that had contributed to traditional IRAs. And as they started to pull the money out, they ran into huge freaking problems. Like I said, when you take money out of a traditional IRA, let's say you take out $100,000 in retirement from the traditional IRA, it's treated exactly like you worked, minus the self-employment taxes. It's treated as if you worked and you get taxed at your marginal tax bracket. You get taxed, using the ordinary tax brackets. So you could go from basically owing no taxes. You pull out a bunch of money from this traditional IRA all at once in 1 year, and boom, now you're in a freaking high tax bracket. Now, let's also talk about required minimum distributions. So what happens is when you contribute to a traditional IRA, remember, you're saving taxes up front. So the government hasn't got their taxes from you yet. They developed required minimum distributions, which is a forced withdrawal. You have to take money out or you get a stiff penalty. And you have to start taking it out when you're 72. They might change the law soon. We'll see. I don't know if they're going to do it. But as of right now, at a certain point in your life, you're going to have to take money out of your traditional IRA and be taxed on it. And the IRS has this whole IRS uniform lifetime table. And basically what you do is you take your account balance at the end of the last year. Let's say you have $1 million in your IRA. You take that, the balance on December 31st, and you divide that by your life expectancy factor, which is a factor that is based on your age. You can see down here, you find your age. I'm 76. Life expectancy factor, 23. You take $1 million, you divide it by 23.7. And that is your required minimum distribution for the next year. You have to take that out and you have to be taxed on it. Okay. I mean, I get it, right? Here's the problem. So we look at this. This is the 1040. Oh my God. Talk about Tesla. Oh, talk about taxing stuff. Shut up. This is actually going to help you. All right. When you contribute to a traditional IRA, you get the tax deduction. Let's say you're retired, right? So let's say you have, some interest. Let's say you have some dividends. Let's say you have IRA distributions, line 4. See this? Now, in a Roth IRA, if you take money out of a Roth IRA, you could take $1 million out of a Roth IRA. And there's no tax. You can take $1 million out and it does not affect your taxes whatsoever. You've already paid the tax. Very flexible. However, what if you go ahead and take $1 million out of your traditional IRA? Boom. Now you go from making technically, a little bit of interest and a little bit of dividends. You'll be in an extremely low tax bracket to being bumped into the highest tax bracket because now you're treated as if you pulled out you made $1 million of income because you pulled out $1 million of income with the traditional IRA. That is the one thing that I freaking hated about this. You have no flexibility. You're forced to take the money out. And the older you get, the more you got to freaking take out. And on top of that, let's say you want to go on a huge vacation and you want to go and give your kids money or something like that. And you pull out $50,000 or $100,000. Well, guess what? You're going to be taxed at a higher tax bracket. Now, let's go look at the tax brackets real quick. Ordinary tax brackets. We'll look at 2022, actually. If you pull out tax brackets, you're taxed in different tranches, basically, depending on how much you make. Now, look at this highest tax bracket here, the 37% tax bracket. Any income, after you do all your deductions to find your taxable income, you pay 37% federal on any income over, if you're single, over $539,900 in 2022, according to this website. So if you pull out $1 million, any dollar amount over this number right here is taxed at 37%. You just screwed yourself. Whereas if you pulled $1 million out of a Roth IRA, this is irrelevant. It doesn't matter. So yeah, people are like, oh, yeah, maybe you're in a high tax bracket now. And okay, maybe you are. And maybe you want to save taxes in the future, or you want to save taxes now because you think you'll be in a lower tax bracket in the future. Okay, maybe that makes sense. And you really should consult your CPA. I'm not your freaking CPA. But what I'm saying is, I've seen people pull out $200,000, $300,000, and they get a massive tax bill because they pulled out so much money. You get slammed. You have no flexibility. It's garbage. I want flexibility. I'm putting money into a Roth IRA and a Roth 401k. I want set up for myself for self-employment. And when I pull money out, I can pull out $50,000. Well, I mean, I don't have to pull out anything. I don't have any required minimum distributions in my Roth IRA. I can pull out $5,000, $10,000, $50,000, $100,000, $500,000. It doesn't matter because the tax brackets don't matter because I already paid freaking tax. Do you see the problem? Okay. You have no freaking flexibility. So it's not the end of the world. Like if you're in the highest tax bracket now and you want to save money on taxes, okay, yeah, you're going to save a lot of money contributing to a traditional IRA. I 100% agree. And, everybody's tax situation is different. But there's one thing that this is dangerous. When you get into retirement, you want to pull out $1 million for whatever reason, you're going to get hammered. So that's my little rant on the freaking traditional IRA. Let's see some comments. Teach me, daddy. Teach me, daddy. Traditional first. Can we get a guest appearance from Strong Baby? He's actually asleep right now, and I am not waking him up. Jeremy's dad got an email from Financial Education Minions. Now, it was a troll, guys. Come on. My problem is I'm making towards the upper limit of the Roth contribution limit. So just putting extra to my 401k. Yeah, at a certain point, you can't directly contribute to a Roth, but there are ways to go in the back door, if you know what I'm saying. But you should consult your tax advisor because I don't know your tax situation. Sorry. By the way, Cole, props on the South. Okay, great. Strawman looks like Jeremy in the prison shower. Man, if I wore this hat in the prison shower, I would be in trouble. Okay. I would be in deep trouble. Man, if somebody gave me, what do you think I would do if I got a $10,000 super chat, ladies and gentlemen? What do you think I would do? I'll give you one guess. Okay, I'll let y'all think about that. Stew it. Yeah, I unplugged my mic. I'm a moron. What if I did this whole video, my mic was unplugged? Let me roast that sissy Echoes. I respect that you don't block people. That's true. I don't block. You know why I don't block people? Because when they comment, it helps me on the algorithm. I don't care. You blew up your IRA with, it said Virgin Galactic. Dude, why are you buying Virgin Galactic calls in your IRA? What are you doing? Not financial advice. What's that? Strong man is a financial man. I am. Okay. Tax evasion is easy. Just put the money in your mattress. Yes, go ahead and do tax evasion. I'm sure that'll work out well for you. Do you feel the same as a traditional 401k versus a Roth? I'm huge into so the funny thing is you have RMDs for both of these, which is weird. You have to have RMDs for the Roth IRA, but it's the same thing. For the Roth 401k. But if you pull $1 million out of your Roth 401k, nothing happens. As long as you meet all the age requirements and stuff like that. If you're in retirement, and you meet all the age requirements, you pulled out your traditional IRA, you pull $1 million out, you're in the highest tax bracket. You're getting screwed. You're going to get freaking hammered on taxes. A traditional IRA only makes sense to get rid of a 401k from the employer that is SE. What do you mean by that? I bet $100 this effer shills VT. You are 100% correct. I am a VT shill. I'd rather pay taxes now, let the funds grow tax-free and not worry about taxes. And you don't have to worry about, because here's another thing. Here's another freaking problem. Your tax situation is going to be more complex, so you're probably going to have to hire a CPA. and they're going to freaking charge you out the butt. Okay. You're going to pay a decent amount of money because they aren't cheap. I do the timers. I know how much we're charging people. It's pretty penny. I mean, it's worth it, but you pay some money. What's your thoughts on traditional versus Roth 401k? I think I'm going to switch 50-50. I mean, everybody's situation is different. I'm a huge fanatic of the Roth 401k. I like Roth because once you put it in there, you pay your taxes, you put it in there, you meet all the requirements, in 59 and a half, you start pulling money out. You don't have to worry about any of this crap. You're just pulling money out and you don't have to worry about taxes. It's beautiful. Will taxes be higher or lower in 40 years? Tell me now. They'll be higher. Just kidding. I have no idea. Let's see. Alibaba dropped more than Voyager. Okay. I guess I should buy Voyager Digital now. Strongman, what are your thoughts on Kevin selling all his real estate? Supposedly timing the housing market. Now he has to pay all these taxes he wouldn't even have to pay if he held. Taxes will kill you, man. And real estate's even worse because then you have closing costs. Real estate is expensive to sell. I have to look at these, like, they're called housing and urban development statements, HUD statements. And I go and look through them with all these people selling their properties. Woo, those commissions and all the freaking titling fees and transfer taxes, and they will freaking hammer you when you sell real estate. It ain't pretty, ladies and gentlemen. Doesn't the bigger amount you're starting with and the compound gains on income more than offset that? It depends. It all depends. But you have, at the end of the day, you don't have as much flexibility. With the Roth, I can pull out $1 million. I can pull out $1 billion from my Roth IRA, which I guess Peter Thiel could do that once he hits the proper age. You don't have to worry about it. When it comes to traditional, you pull out $1 billion, your butt's gonna be bleeding. Strong man, just deposit from your traditional 401k to a QCD. Qualified charitable distribution. I mean, yeah, but that's limited. You can only do like 100,000 a year. But the compound gains on the higher amount in traditional. Yeah, I mean, if you just compare apples to apples and you just look at the beginning, sure, you're gonna, maybe have more, maybe. But when you start pulling it out, that's where the problem arises. Not when you put it in, it's when you pull it out. That's when you have issues. Let's see. Roth is a double-edged sword. I've done some degenerate trading on there because tax wasn't a factor. I mean, you can trade inside a traditional too, and you don't pay tax. It's when you pull it out. That's when the taxes hit. When you have something inside a Roth or an IRA or a 401k, it's sheltered in there. You can trade, you can get interest, dividends. There's no taxes. When you pull it out, that's when the taxes come in for the traditional. Let's see. The Canadian TFSA is Roth on steroids. Look it up. I'm jealous. Please don't leave me, strong man. I'm going to get deleted one day, guys. I am. I guess the only reason someone would have a traditional IRA or whatever is that they max out. Well, you can only do one or the other. I mean, you can do like 50-50, as long as you meet there's so many like phase outs and this and that. It's not just like a easy thing to say, but if you can't put 6,000 into a Roth and then 6,000 in traditional. You're limited. It's either 6,000 total or 7,000 if you're 50 or older. So that's kind of how that works. Do I need to pay taxes on poker winnings on an offshore website like Bovada? Well, according to the IRS website, you are taxed on your worldwide income. So that's all I'm going to say there. You should probably go talk to a tax person, have them look at your specific situation. Most likely, yes. How can Peter Thiel have $1 billion in his Roth IRA if the max contribution is $6,000? So he put the money in, and then he bought, what was the stock? He had stock in a company when it first started, and he had insane gains. So all that money was in there, and now it's growing tax-free forever. So this dude could literally pull out $5 billion or whatever he has and not pay any taxes. Try that with a traditional, see what happens to you. You will be selling your butt for taxes. I need to go down to the truck stop after this. For what? Did you lose money watching this video? Hey, bud. Boom, 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 boom. What do you think of these two quick for Roth IRA? GFFX and AMCFX. By the way, keep the intro. Keep up the good word. All right, let me go look at this real quick, and then I'm gonna cut the video because I'm actually exhausted today. Oh, I stopped sharing my screen. I'm out of it today. Kids freaking killed me last night. Oh, it was brutal. All right, GFFX. GFFX. What's a mutual fund? That's GFFX. The Growth Fund of America. Expense ratio, very high. Let's see. What do they have in this thing? I mean, I'm an index fund guy. This doesn't sound like an index to me. So, what does it have? Portfolio turnover, that's not horrible. 10-year returns, 13%. Okay. This is probably this is probably all U.S. stocks, right? Oh, my Lord. Look at the top holding. Tesla, buy Tesla, bro. So, if you buy this, 7% of your portfolio is Tesla. 6%, yeah, this is basically like a large cap U.S. fund. I guess they have a little bit of like Europe and Asia sprinkled in, but it's basically United States. So, I don't know. I'm not a huge fan. Perfectly, I'm a global investor. You have a little bit of global exposure, that's fine, I guess. But Tesla 7%, for the love of Christ. And then you got fees, 0.4%. You can get way cheaper than that. That'll be a drag on your returns. Turnover is not horrible. Turnover is just like how much they flip-flop the portfolio every year, which, generates taxes, capital gains distributions. It's not horrible. I mean, it's not the worst thing in the world, but I wouldn't personally buy it. What else? AMCFX. You do you, okay? I'm not going to tell you what to do. AMCFX. American Funds AMCAP. Class F2. What's in here? Okay, U.S. stocks. Let's see. Blah, blah, blah. Turnover, not horrible. 10-year returns, 11%. Compounded. Okay. Well, this is a little bit better. I can tell you right off the bat because it doesn't have freaking Tesla as the number one. Microsoft, Apple, Amazon, United Health. I mean, you could get this in an index fund. It's all the same freaking stocks. 88% US. I mean, this is just an actively managed fund. I mean, the whole argument, either you like index funds or you don't. Okay, with index funds, you get lower fees, lower turnover, you track the market. Actively managed funds, they could potentially beat the market, but they have higher fees. They have higher turnover, which means more capital gains distributions, which means more taxes. And your fund manager could screw up and then you're screwed. That first one, I didn't like that first one. Tesla, 7%, for the love of God. What's the expense ratio on this thing? 0.43? Come on. That's expensive. That's ridiculous. You can get an index fund. It's like 0.03 for VOO or VTI. I mean, those are okay. That's not the end of the world, but I'm not a huge fan. You do you, man. I'm not going to tell you what to do so you don't sue me. Strongman said to sell it, and then it went up 10x the next day. All right, guys. Well, that's it. I'm freaking tired. Hope you have a wonderful night. Cue the outro.
Oh, merry stock market. Oh, man. Woo!